Today we look at the fastest growing company to ever hit $100 million in recurring revenue. We tackle the tricky balance between being fully invested and making sure you have some dry powder on the side. And we have a community member's portfolio go under the microscope to get some insights from our expert, Adam Dawes. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot happening that we are going to cover on markets and investing.
Today's headlines, there is plenty going on around the world when it comes to trade and tariffs. As we said, Lovable is the first company to reach 100 million in recurring revenue. And Ren, a company claims that they have been able to achieve what previously has been thought impossible. But let's start with the tariffs.
News and markets.
All right, yes, trade talk. It is back on the agenda again. Unsurprisingly, there's probably three key stories we want to hit here. Australia, the EU, and China, all related to the US, of course. Let's start here in Australia. We kind of avoided Liberation Day when it first kicked off. We only got the 10% baseline tariff, and we thought we were all good. We stayed out of the headlines.
Yep.
But things have now changed with a warning that we may be getting 15 to 20% tariffs on the 1st of August.
A warning?
Yeah, a warning. But yeah, a warning that if we don't make a deal.
So Albanese is already trying to improve his position at the bargaining table. We've seen recently he's lifted the ban on beef exports to the US, which was a big thorn in the side for Trump.
Yeah. I mean, technically they weren't banned. It's just that we had biosecurity rules that the US couldn't meet.
Yes.
Yeah.
Sorry, it wasn't exports, it was imports of US beef.
Yeah.
So they're, I guess they're reducing our biosecurity laws.
Yeah, well, it was all about tracking beef that originated in Canada and Mexico, and the US didn't track it. They have actually improved their tracking, but yeah, you don't like to see Australia fold.
No. Anyway, plenty going on. We'll keep an eye on it. But over to Europe, where the Europe and the US, or the European Union and the US have reached a trade deal. America has threatened 30% tariff on European imports, but it's been cut to 15%.
The US has halved their tariff. In return, the EU has agreed to buy $750 billion worth of American energy, make major purchases of US military equipment, and invest an additional $600 billion into America. It is interesting that a lot of these trade deals also come, that like Japan had a similar deal where there was like an $100 billion to be invested in America. That's one deal which is good to see. It's about 30% of global trade is between the US and Europe, so like massive markets.
Yeah.
It's been interesting to see a number of the European automakers have been getting slammed by tariffs in this earnings season. They've been reporting it. Volkswagen, I think, was like $1.5 billion tariff bill for the first 6 months. So yeah, they'll be pretty happy. So that's European Union. And then China was the last one. Unsurprisingly, the US and China had a 90-day pause. That was set to expire on the 12th of August.
Yeah.
The South China Morning Post first reported that the US and China are going to kick that can down the road and extend that pause for another 90 days.
I mean, it's the one market I think that the US is probably most worried about. So I'm not surprised they keep kicking it down the road.
Well, yeah. I mean, they also keep kicking the TikTok ban down the road. At the same time, Chinese rare earth exports to the US massively increased from the sort of lows in May. And the US has lifted their export ban on the H20 NVIDIA chips, which are like not the most advanced ones, but the ones made for China. Some loosening of some of the restrictions on either side, I guess you would say. Here's an AI company you may not have heard of yet, but we're confident it's going to change your world. Let's talk about Lovable, the fastest company to ever reach $100 million in annual recurring revenue.
So what is Lovable? On their website, they say create apps and websites by chatting with AI, and effectively that's what they've built. They've built an engine where through prompting alone, people are now building incredible apps and websites in mere seconds.
Yeah.
It is unbelievable.
It's nuts, and we're going to take you through some examples today because it's hard to explain just how impressive it is.
Yeah.
But to just talk about the business story first of all,
Yeah.
it took them 8 months
Yeah.
to go to 100 million in annual recurring revenue. To put that in perspective, Shopify took 6 years to get to 100 mil. Twilio took about 5 years. Slack, 3 years. OpenAI was about 18 months. There's a couple of companies I haven't heard of. I'm not sure if you know them. Wiz or Cursor?
Wiz was the one that Google bought.
Oh, that's right.
Yeah.
Yeah. So they took a bit over a year. They were less than OpenAI.
Yeah.
Have you heard of Cursor?
No.
Probably some AI company.
Yeah.
But Lovable, fastest ever to go from 1 mil to 100 mil, 8 months.
8 months. Not only that, they've done a Series A of 200 million within that period, valuing them at $1.8 billion.
You know what I like about this company?
They're Swedish.
Not American.
Yeah.
Nothing against our American viewers, but it's just nice to see technological innovation dispersed throughout the world, shall we say. Yeah.
Just to put some other numbers to it, Ren, they're now the 4th fastest growing website in the world by total traffic. And they just overtook ChatGPT in new visitor growth after only 8 months on the scene.
Now, the first time I heard about this company was I saw on Twitter someone had rebuilt DocuSign in 2 days using Lovable. And then DocuSign, I think, sued them and shut it down. But that has started a flurry of people people rebuilding websites in an incredibly short period of time. Yeah. So we got a couple of videos that I think just illustrate it. Have you heard of Fall Guys?
No.
I'm asking the wrong person. Anyway, here's one I saw on Instagram where someone rebuilt it in 60 seconds.
I'm gonna code Fall Guys in 60 seconds using only AI to prove that y'all's jobs are cooked. I'm gonna go on ChatGPT and ask, describe Fall Guys in MVP terms. Then I'm gonna copy that prompt, paste it to lovable.dev, and now I literally don't have to touch my keyboard again. Just like that, the AI tells me what it's gonna do and starts coding for me. Oh, okay, and now we have Fall Guys. And just like that, we can do parkour and jump around.
Wild. It is wild. It is wild.
So that's impressive.
At your fingertips.
Yeah. But I think I found one that was more impressive. You're a big YouTube guy.
Yeah.
How about rebuilding YouTube?
YouTube clone.
Then I'm just gonna rebuild YouTube from scratch in under 30 seconds. This is how. Okay, firstly, I'm gonna go over to Lovable.dev, and then I'm gonna connect to the backend. So I'm just gonna go over here.
That is phenomenal.
Yeah.
It's phenomenal.
Yeah. Lovable is what we're talking about today, but it is just the tip of the iceberg of what's coming down and what we should all be ready for, because there are other platforms doing similar things. There's one called Emergent AI, and someone built a Spotify clone. So have a look at this.
But for AI songs, interesting.
So it doesn't look exactly the same.
And all the songs are AI.
I guess so, yeah. But like pretty good functionality.
Yeah, amazing functionality. I might rebuild the afl.com.au website.
Yeah. I might rebuild the Equity Mates website.
I think it's pretty incredible seeing some of the companies come out of this space. I'm sure, unfortunately, we're going to... The investment opportunity for us is one that I'm still...
I was actually thinking about this morning as I was coming to work, and I was like, like Lovable, you can't invest in all of this stuff. They're going to stay private for longer as well, because there's just so much money sloshing around this space.
Yeah.
But like maybe the biggest investment opportunity is the most obvious.
What's that?
Just buy Nvidia. Like all of these companies are just powered by one
chip, yeah.
Or buy Nvidia and the 3 hyperscalers.
Yeah.
Like Amazon, Microsoft, Google.
Good point.
Not investing advice, but it's like we talk a lot about picks and shovels.
Yeah.
And though just because these companies are massive doesn't mean they're not the most obvious picks and shovels play. And like this is a complete tangent, but like have a look at Google's result. They knocked it out of the park, but particularly Google Cloud, which is their data center business, starting to display some pretty impressive operating leverage. Google search revenue is up 12%. So does that eliminate that concern around AI taking search?
Maybe. Long term, I still think we're just going to interact in a completely different way, and I don't know how they play in that from a search point of view. Yeah. Anyway, I just see how many people use ChatGPT.
Yeah. I reckon everyone that uses ChatGPT would still Google something at least once a day.
Probably.
Yeah.
Yeah, but not 50 times a day.
Anyway.
It's never ending. Oh, investing.
All right, well, let's close out as we always do with our What The, and we feature this every day in our news email where we give you a dot point summary of the news moving markets. Sign up at the YouTube description or the podcast show notes. But Bryce, from ancient Greece to China to the Islamic Golden Age to Isaac Newton, one thing has befuddled scientists for centuries.
Yeah.
Can we turn base metals into gold? And while humanity could never do it, one startup in San Francisco claims to have solved alchemy.
You're right, Ren. Well, so San Francisco-based Marathon Fusion claimed they, as you said, nuclear fusion company. They believe they have achieved, as you said, what people have previously thought to be impossible, which is turning base metals into gold. They've managed to turn mercury into gold using a process known as nuclear transmutation.
Yeah.
Wow. So is the idea of gold being this rare, finite metal now done and dusted?
Yeah. Maybe gold will lose all its value.
Yeah.
No, so nuclear transmutation, they're literally like changing the nucleus of an atom. They're
Wow.
changing the number of protons. They claim they have turned mercury into gold. Now, before you worry and go and sell all your gold stocks or, liquidate your gold ring because you're worried it's going to lose its value, don't panic.
Okay.
This gold is so radioactive that you can't physically touch it for between 14 and 18 years.
Nice.
But still, pretty impressive.
It is impressive. It is impressive nonetheless.
Hello, IT.
Hello, IT? Have you tried turning it off and on again?
Have you tried forcing an unexpected reboot?
In the Unhelpful Desk, we receive plenty of questions from you, some of which are borderline personal advice. So in this segment, we give very general advice to your specific questions.
That's right. We've got 2 questions to answer today. The first one comes in from Dustin.
G'day boys. Recently I was fortunate to sell one of my properties which settled right before Liberation Day, and this meant I was in a position to deploy a meaningful amount of capital into the market and have done reasonably well from it. Now, as a long-term listener, I understand why one shouldn't try to time the market and to always aim to dollar cost average into the market instead. And equally, thanks to you gents, I also know that there's been no market downturn in history that hasn't been worth buying. So this has got me wondering what your thoughts are, whether there are any general recommendations around how much cash as a percentage, still the majority of the cash invested so that they're not missing out on the long-term benefits of being invested, yet having enough dry powder on the side ready to take advantage of market downturns. Cheers.
Love your question, Dustin. Thank you for recording it as a voice note. You can ask your question at equitymates.com/contact. Now, the reason that we can only give general advice to this question is there's no perfect answer here. How much cash you should have on the sideline, how fully invested you should be, does depend on things like your time horizon, your goals, your risk tolerance. But we can certainly give some general thought starters.
We can.
So where would you like to start, Bryce?
Let's start with the academic literature and what it tells us.
Yep.
And it generally tells us, if we're to sum everything up, get as much money into the market as you can.
As soon as possible.
As soon as possible.
Yeah, and then
Yeah.
keep doing it.
And then keep doing it. Yeah. So there are studies that try and compare the difference between dollar cost averaging and lump sum. And it shows that if you put a lump sum in, you're generally better off.
Yeah, and part of the reason for that is that the more cash you have on the sidelines, the more it is a drag on your returns because that cash obviously isn't earning as much. And, you might get lucky and there might be a market fall 6 months from now and then having that cash to deploy is great. But if it's 6 years from now and you've missed out on, 8, 10, 12% a year for 6 years, you're constantly playing catch up, even if the market falls 30, 40 or 50% and you nail the timing of that deployment, which is a big if. The best book I've found that isn't academic, but sort of explains some of this research is Just Keep Buying by Nick Majuli. So you can read that to also prompt some thoughts. But I think maybe let's answer how we approach this question because it is certainly something we think a lot about personally.
We automate a lot of our investing. So every time we're paid, we transfer from our salary account into our brokerage account. That money that goes into my brokerage account is 100% invested. Then there's some that I transfer to our offset account, and that's where I sit dry powder.
Yeah.
If I then an opportunity comes up, Liberation Day, bang, I'll take it out of my offset. The reason I do that is because I prefer my money to be working a little bit harder than it is just in the brokerage account. Because while it's in the offset account, it's reducing my interest ever so slightly.
Oh, man, it's giving you a 6% after tax return.
Yeah,
which is great.
So that's how I do it. In terms of split, it's like 80-20 in terms of total investment or like total cash.
Yeah. I get paid fortnightly, and about 60% of my investment/saving money goes into my DCAing, and then about 40% goes into, I just constantly top up my emergency fund, and then I also put some into my satellite brokerage account, which doesn't get automatically invested, but is put in that environment and is ready to go.
Yeah.
And so whether that's to deploy when there's a dip or when I just hear about an opportunity that I think is pretty exciting, there's some dry powder sitting there ready to go. Yeah, I don't have a specific bucket of money that I say this is only for a market dip.
Yeah.
It's just like I have a bucket of money which is like opportunistic
Usable.
in the general sense, however that opportunity arises.
Yes.
I think one other thing to think about when answering this question is it's not just a question of cash in the market or cash out of the market. You could also think about assets that will move inversely to the market or that will hold their value in a market downturn and that are liquid so you could sell and redeploy. And the two obvious examples that come to mind are number one, gold, and number two, bonds.
Yeah.
So bonds traditionally have moved inversely to the share market. And so they've been a good one to sell when there's a market downturn and then deploy into equities.
Yeah.
Similarly, gold as a store of value. That's had a pretty good performance just generally. But, if you have 5% of your portfolio in gold, the market tanks, you can sell that gold opportunistically buy.
Yeah. All right. Thank you, Dustin, for the question. Now let's hear from Mark.
Hey guys, my name is Mark. I'm fairly new to investing and a fairly new listener to your podcast. But I've started with 10K and I've put half in Vanguard S&P 500 and the rest spread across Eli Lilly, Palantir, and Nvidia. First, I wanted to know if this was a good starting point, what I've invested in, or if I should have kind of done something different. Also, I guess I wanted to see if it's worth it. Look, I've got a bit of spare cash lying around, and I thought, I'm kind of prepared to lose if I have to, but maybe try something a bit more high risk where, more, I guess, short-term high rewards, but obviously the risk of losing it. I wanted your advice on how I should go about it. Also, I guess maybe if I should do it myself or if you had any tips or should I be going through a stockbroker? But yeah, any help would be great. Thank you.
Well, Mark, thank you for the question. Again, there's some quite specific questions that relate to you and we're not aware of your goals and circumstances. So we'll answer it generally. But I think we should just start with a congratulations to Mark. So we actually got this voice note at the end of last year, but it was before we were doing the Unhelpful Desk, so we didn't have a way to respond to it. But I had a look at the 4 investments that Mark had made. So the S&P 500 index, year to date, that's up 9%. Eli Lilly, up 5% year to date. Nvidia, up 25% year to date. And Palantir up 111% year to date.
Nice, Mark.
So Mark must be loving investing.
Love that. Well, let's tackle the sort of main part, I think, to the question, which was thinking of doing something more high risk.
Yes.
It's like he's got his money in the market, feeling like he should do something more high risk. Mark, I would say you're pretty high risk at the moment.
I think so.
I think you're pretty high risk. You're long America, your S&P 500, your Nvidia, your Palantir. You're also like ultra mega cap. So you're very concentrated from the individual part of your portfolio.
Yeah, and I would just say from like a thematic point of view, you're very long like overvalued momentum and like overvalued on traditional metrics. But like Palantir's got a eye-wateringly high valuation. Nvidia and Eli Lilly, they're obviously all growing very quickly. But yeah, you're in the growth risk quadrant of the market already.
Yes.
So I don't think you want to go more high risk. I think listening to Mark's question, he was kind of talking about like short term, like make a heap of money or lose a heap of money.
Altcoins, yeah,
Like that's
yeah.
it's not the game you want to be playing, Mark.
No.
There are sensible ways to find growth opportunities, and then there are dumb ways to gamble.
Yeah, I think if you wanted to do the whole I'm prepared to lose my money play, you want to shore up your core positions a little bit more. And by that, I mean...
Well, that's not prepared to lose your money.
What I mean is
I would say if you're prepared to say, I want to double my money or lose it, go to the casino.
What I'm saying is before you go and splash your cash, shore up your core from just Vanguard S&P 500 and get a bit more exposure so that your core is a little bit more diversified.
Yeah,
You've got a stronger
definitely.
foundation.
I think that's the right general advice.
Yeah.
Just weird that you prefaced it with if you want to lose money.
Well, I mean, like then go and have some fun with your satellite. But like you're long US at the moment. Like get your foundation in a better position, then go and have some fun with your satellite.
Or just get your foundations in a better position.
Yeah, well, sure. Both the same.
But yeah, I agree. Like that's the obvious thing to me. Like be globally diversified. Like Vanguard S&P 500 is a great start to your core, but just the US may not win the coming decade and the decade after that and the decade after that.
Yeah.
But you're up 111% on Palantir in half a year. Like you don't need more growth than that. So yeah, I think for me it's like if you've got spare cash, build out the core.
Yeah.
The second part of the question was stockbroker or do it myself.
I mean, in this day and age where you can get access to global markets, everything that you need to build a diversified portfolio at ultra cheap prices, I wouldn't be doing like a full service broker. You're going to pay $100 to $125 a trade if you're getting someone doing it for you. And nowadays you can get anywhere from $2 to $3.
You can
in
get
some
it for free.
instances, you can get it for free.
Yeah.
So no need, in our opinion, to get a full broker service at all.
Sorry to all the full service brokers out there.
If you have a question that you'd like to get us to answer on the Unhelpful Desk, head to equitymates.com/contact, leave us a voicemail, and we'll make sure that we get it onto the show. We love hearing from you guys. We're going to take a quick break, and on the other side, we've got a community member who is putting their portfolio under the microscope in our Pimp My Portfolio segment with Adam Dawes. We'll be right back. Welcome back to Equity Mates. It is time for...
Pimp My Portfolio. Pimp My Portfolio.
That's right. We have a community member on the line who has submitted their portfolio for our expert to review and provide some ideas on how to improve. And our expert today in the studio is none other than Adam Dawes. Dawsy, how are you?
Really well, thank you. It's great to be here.
Thank you for being here. And we have Natalia on the line. Natalia, how are you?
Good. Thank you so much for having me, everyone.
Well, thank you so much for submitting. Now, before we jump into it, can you just introduce yourself?
Yeah, I'm Natalia. I am based in Melbourne, and I work in the mental health field.
Oh, nice. Well, you've submitted your portfolio for Adam to put under the microscope. So, Ren, why don't you take us through it?
So Natalia's portfolio has a number of ETFs and then 5 individual stock holdings. So if we start with the ETFs, together they make up about 85% of the portfolio. And I'll just run down the list. So we've got S&P 500 ETF, IVV, Vanguard Diversified High Growth, VDHG, BetaShares Global Sustainability, FE, VAS, Vanguard Australia, VGS, which is Vanguard MSCI All World, IXJ, iShares Global Healthcare, NDQ, BetaShares Nasdaq 100, and then closing it out, IEM, iShares Emerging Markets. So that's the ETF section. And then we've got a number of stocks. We've got Goodman Group, BHP, Rio Tinto, Alphabet, and CSL.
Love it.
Do you have a nickname for this
Well,
portfolio?
this is a very healthy portfolio, Natalia, since you're in the healthcare space and you do own some healthcare stocks in there as well. So a very healthy portfolio.
Nice. That's a good early sign. Natalia, do you want to tell us a little bit about how this portfolio came to be?
Yeah, well, a lot of the ETFs, they came from when I started investing. And when I started my journey, I got on ComSec Pocket and then just bought pretty much everything because I didn't know what I was doing. And it was only recently that I'm like, okay, you know what? Maybe I should get to know more about like what I'm actually buying. So with the stocks, it was just a little bit of I'm interested. I don't really care about like the overlap that they have. They're already in the ETFs. It was just for the funsies, and and then now it's more so the S&Ps and focusing more on like the growth. So yeah, I guess that's how it came to be.
Nice. And so just how are you actively investing at the moment? Are you averaging in every month, or is it just bit by bit? How are you investing?
Yeah, for the past year and a bit, it's been quite consistent. I've recently taken out equity, which I haven't spent yet.
Nice. Dry powder.
We like that.
We like that, yeah. So Adam, what are your thoughts?
Natalia, I think you hit the nail on the head as far as overlap. This is certainly something in the portfolio that you are overlapping in some of the stocks or the ETFs in the portfolio, something from the IVV to the Vanguard Diversified Growth, then to the Vanguard MSCI, and then to the Beta Shares 100. So I think that would be the first port of call, is looking at and you can go into the fact sheets on their websites, and you can actually look at country diversification. You can, there's even a button that you can click on. You can look at all of the holdings underneath those ETFs. And so I do a little bit of homework on, especially the IVV, which I think is fantastic, and you would keep that. But then looking at the Vanguard Diversified one, and then the MSCI, and sort of think. And there is a lot of overlap. I know that's in the portfolio, and then even in the NASDAQ 100 as well, you're going to get some overlap as well. So if the US market, as we have seen, has taken a fall, your portfolio will fall as well, but it'll also fall a little bit more exaggerated because you've got so many of those double ups in there. So I think you're aware of that when you said that, now. But I would do some more homework on that and try and streamline the portfolio a little bit more.
So Dawesy, with that overlap, there's, I guess, like a couple of different choices you can go. There's the VGS, which is Vanguard International, and it's just like market cap weighted, biggest to smallest companies. And then there's something like VDHG, which is global as well, but it's got like it's more set weightings for different markets. And then there's some, individual company country ETFs that you can piece together to build a global ETF portfolio.
Yeah.
Do you think there's one right way, or do you have a preference?
As an advisor, I would like to do it myself instead of leaving it up to Beta Shares or Vanguard to do something like that. So you can definitely use regions. So you can buy a European ETF, you can buy an American, you can buy an Asian ETF. You can sort of piece together that kind of stuff as well. So I like to do it myself, and I think that gives you some more variability. That's not the right word. It gives you more control. Thank you, Bryce. Control over it, because at the moment Europe's doing really well, right? And so you'd have more money weighted to that area. US is going to struggle for the next sort of 6 months to 12 months with lower growth, and you can then, instead of allowing Vanguard to or whoever to do it, you can then weight the portfolio a little bit more, and hence you have more control.
Nice. Yeah. If we get to the individual stocks, some good names there. So 5 stocks: Goodman, BHP, Rio, Alphabet, and CSL. How do you think about those stock picks? Yeah,
look, they're fine, and certainly something, Goodman Group we've spoken about. I think it's a fantastic business. BHP, Rio, look, iron ore, it's certainly a stable for Australian businesses and for clients, and CSL certainly as well. So I think you're staying with the quality, and that's exactly what you need to be doing. With the dry powder, though, that you've got, I would certainly look to build out some of that Australian exposure and picking some of the eyes out of that, but then also moving to potentially some of the international stuff as well. So you could build certainly out. You really want sort of 10 to 15 or 15 to 20 stocks in your portfolio. So there is room for you to build some of that out. I think the ETFs, we could talk about the overlap, so you could streamline that. And then looking for the Australian market. We think the Australian market over the next 12 months is going to be better than the US market. It's a big call on my behalf, but I think Australia is looking like it's a bit of a safer investment place. There's less problems going on here, and we've got somewhat of a stable government and a stable currency. So I think we're seeing a lot of money, international money, coming into Australia. So, yeah, with that dry powder, you could certainly build out that Australian component of the portfolio.
So Natalia, what are your, I guess, initial reactions to some of those comments?
Yeah, I think that's pretty much what I've been thinking about for a very long time, especially with the vast VGS and then BDHD, which is pretty much same-ish. And yeah, I guess with a lot of the overlap, which I am very much aware of, it's just like on top of my on the front of my mind. But also thinking about whether it would be a better idea to, like the typical, do I sell, do I rebuy other things, or do I just put more into the ones that I really want, or the ones that I chose for the longer term?
Yeah, I think you can certainly do that, and certainly if you're aware of that, I think taking action is certainly where the market is at the moment. I wouldn't have recommended selling and reweighting the portfolio when the market was a lot lower. So now we've come back up. I think the market is going to struggle here a little bit. So it's probably, and I called a couple of clients yesterday just saying, look, let's just take a little bit of money off the top here. Let's change the portfolio around a bit for the next level of growth. So I think it's the right time now to be looking at sort of streamlining that portfolio and potentially adding some more to that. So I think you're definitely on the right track, Natalia.
I think particularly if you're about to deploy a fair chunk of cash as well, you probably want to think about getting it in the structure that is right going forward.
Yeah, definitely.
And so if that does mean selling down some of the ETFs and building the core in the way that you want it going forward, then I think that would be something to consider.
Mm-hmm.
I'm not the expert though.
Well, you've been doing a podcast for a long time, so yeah, you could, yeah.
Well, Natalia, did you have any other questions for Dawesy while you've got him here?
I mean, like with what you've shared, that is a lot of things to sponge in. A lot of the questions that I initially have were answered pretty much while you guys were talking. So no, yeah.
Awesome.
Right. Yep.
Awesome. Well, thank you so much for submitting your portfolio. I think, I think a lot of people listening are in a similar situation with a number of ETFs and some overlap to consider. So I'm sure a lot of listeners today were able to get a lot out of what we just discussed. So Natalia, thank you so much. We really do appreciate you submitting your portfolio.
Thank you again, guys, for having me.
Now, if you would like to sit down and not necessarily reveal your portfolio to the world, but have a one-on-one conversation with Adam about your portfolio, then Adam does have a service for the Equity Mates community, a portfolio health check, where he'll sit down, go through your portfolio and align it with your goals and your risk profile and provide you with a professional statement of advice. $825 and you'll certainly be put on the right track. So head to equitymates.com/advice and there'll be a form there for you. But Adam, thank you so much.
Thank you.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.